Alrighty then. Gonna start in 1 second. Just waiting for everything to go online. Almost. I'll just go ahead and start. All right. So this market is chaotic, if I can say the least. A few interesting things happening in the market so far. This week has been definitely a turning point. Where to begin? That's the hard part. Where do we begin? So let's go ahead and begin with our SPY predictions. So let me go pick up our SPY or SPX, doesn't matter which one. Now, the last week has been indecisive, for the lack of a better word or description. But it seems to be choosing the direction it wants to go. Based on my predictions, it is very, very soon, but you cannot predict events around the world. The new Omicron virus is a big reason behind these moves. Not only that, but the federal government ending tapering, or considering soon to end tapering and to start raising interest rates, is also another factor that we are dealing with. Two catalysts, negative catalysts at once. The next catalyst would be around the December 10th, where we have to be aware of whether our US budget is going to increase or if we're going to stop increasing the debt. And then we have a degrade to the United States credit rating. That is not too far from now, but the beginning of December has been very, very chaotic so far. Now, if we look at Tuesday, the first was Tuesday, right? Wednesday, the first was Wednesday, Tuesday. So it did become a bit of an issue. Friday, right? So Friday after Thanksgiving, we had a bit of an issue, a bit of a downturn. Monday, we recovered a little, but Tuesday and Wednesday are the big red days that really took power in the direction of the whole market. Now, I want to be clear. The US market has been going up for so long. I've mentioned this multiple times before. The reason for that is unknown. There's no logical explanation to this. In fact, if we look at the Warren Buffett indicator, which is basically an indicator that compares the current market to the actual GDP ratio of the country itself, we see that this straight line, this parabolic straight line, is a kind of a guidance or a gravitational pull for the overall market to kind of gravitate or guide itself around. Now, when we're observing the actual GDP of the country versus where we currently are sitting, as far as our actual value for the market, we are at about a 200+% overextended value. Now, this hasn't happened very often, but you notice that anytime we drift far up ahead, internet bubble 2000, or drift below, we tend to kind of slingshot back to the GDP of the country. It hasn't quite happened very much lately. The 2000 internet bubble was the first instance where we were overinflated and it crashed down, but everything recovered in a kind of nicer manner. 2008 mortgage crash, boom, housing crash. That affected the whole world and the US dollar as a whole. And then we even see it act as resistance in many cases. Resistance or support. Support here, resistance here. So this line is definitely, or the fact of the GDP being the gross product of the country, meaning how much is the country producing, is a very balanced format of where we should technically be on a healthy market. But the market right now is far from healthy. In fact, very overextended, very over-exaggerated, and potentially in verge of a collapse. So, where are we today? Today, of course, we've had our very first few big red candles. I mean, we're looking at 75 million volume, 132 million volume, 148 million volume. If we've looked back at any big candles like this, 140 million volume, but having them one after another does happen. This one was before in September, end of September. We've had a few dojis at 140 volume, but recovered. And if we step back to where was it? Our great crash here. What are we looking at? We're looking at a 200 million volume negative, 200 near, 280 near 300, 300 million. So we are a bit off from a huge crash as we happen to have in our COVID beginnings. However, we're not too far off from the general downturn. This one is 120, this one's 200 as well. So we haven't seen a 200 volume candle yet in the last week or so, but it is also kind of the beginning. 75 mil, 127 positive, 132 negative, 148 negative, 112 negative. So not so bad, but other indicators would tend to kind of I guess rebuttal that. So if we take a look at a few factors here. One factor, the VIX volatility is very high and continuing a trend, battling for the 30 value. Now 30 is a significant place because we haven't reached 30 in a long time. We've only reached it during the crash, a couple of warning 30s in the past, but the crash itself was a huge 30 bypass, and on the way down, cooling off, we hit that 30. We haven't been to the 30 since January, the beginning of the year, which is debatable for what happened with AMC and GME squeezes, causing a little bit of a stir in the market. So that was an interesting 30 hit. But that was a day or two, right? We were up there for 1, 2, 3 days positive, and then the next 3 days negative. Today, we're not up there, but we're building up to 30, which means it's a stable growth, meaning volatility. The volatility is increasing. The movements will be very drastic to our overall market in the coming week. Very drastic in the up or in the down. But in this case scenario, the volatility is getting higher, which normally means a type of fear. People that use the VIX or that bet on the VIX are betting on the fear of the market. So since we're basically fighting on that 30, we've broken into it a few times up to 32, but calm down and probably going to close around the 30 value. Well, I am using a different candle set, the Heiken Ashi, so this is going to give me averages. If I go back to regular candles, we actually are very much above that 30 value. We are sitting at 32.69 at the moment, but the averages are still building up. We had a huge volatility candle here. Then we had one slight maybe doji, which attempted to cool it off or maybe pretend that, oh, nothing's happening, we're about to reverse. But then the next averages are still building. In an average of the Heiken Ashi candles, this is normally a build up to higher, bigger growth of the candles themselves. But in the actual values of the day, we're sitting at 32.80 and possibly going to be fighting or closing above 32.66, which was the high the other day on Wednesday. So a few factors are happening around the world that are actually contributing to this. One, they're finally kind of admitting that the Omicron is very contagious, much more contagious than previous viruses. But I'm not seeing a lot of actual messaging of the fact that it's not as deadly, which actually bodes well for us humans. If we get a virus that is not as deadly but more contagious, we get the ability to naturally get immunity from this virus. Now, there have been no crazy stories yet about the death rate increasing from the last from Omicron, but it hasn't been enough time. That's kind of the key too. It's only been a week, if even, for this virus to really be detected on the radar. So the kind of suspicious thing I'm looking at is that the news is very big on making people scared. So they're definitely giving a bit of a umph to the fact that Omicron is more spreadable, but not much is being said on the fact that so far, on the same sort of level, it's not as deadly as Delta or other variants, which would again bode well for us. So I don't see it as horrible news about this virus. In fact, I see it as a good way for us to get away from the continuous spread. It's like the flu. We get the flu, our body builds an immune to it, and then we have a stronger susceptibility in the future. Of course, the flu changes all the time, but our body's previous historic occurrence with the flu helps us overcome it in the future. If you automatically introduce a kind of control subject, let's call it a clone, a human clone that has no immunity, and then this clone goes through that flu, it has a higher chance of dying because it doesn't have the past immunizations, natural immunizations, or if you have the shots, but normally most people go through the natural form, and the clone will have a higher chance of dying because it has no actual exposure to this virus, the flu. So in our case scenario, we're building immunity as we go, and it looks like we're hitting on the 33 on the VIX, which is actually very, very scary. We're getting to a higher set, and the news of this omnivirus is getting big. Let me diverge away from the virus, whatever the case is. Another event happening is Germany is going on basically complete lockdown. No one can go in, no one can come out. People that are vaccinated are the only ones allowed to go out in public. So this is kind of becoming is being looked at as the possible new path for other countries as well, especially the United States. So far, Biden has said he will not go through a lockdown, but politics, events, we don't know if that's for sure. Okay, so those two events have basically spurred our current candle, our green candle in the volatility. I've also been keeping track of the put calls. For a brief moment, the puts on the market were lower than normal, around this value, around the 0.98 value, 99 value, and then it just burst up again. So that's kind of another issue with the put calls. This is the act of derivatives in the market. So people betting whether it's going to be a bullish or a bearish market, whether it's going to go up or down. The higher the number actually means that there's a bearish signal, meaning that people are betting it's going to go down. But the lower the number means that they're basically betting it's going to go up. Right now, over the one value, which is right here, over this one value signifies that the puts or the bears or the guys and gals that see the market going down have overcome the calls. Again, a put call, puts are negative, calls are positive. It's literally put divided by call. So if it's higher than 1, the numerator is greater. But if it's lower than 1, the denominator is greater. So right now, above the 1, we have the numerator greater than the denominator. So our puts are higher, which means people are betting that the market's going to go down. Now, I've been watching this closely and trying to relate it to the volatility of the market. And I noticed when the market kind of cooled down a little bit today, the puts were still pretty high. So I didn't make any moves. I'm waiting to get a big discount Currently, I'm down a whopping $7,000, which is great. But I have moved off now that I know the direction and I see the direction of the market. I have moved off a good chunk of money into cash and crypto, waiting for that dip buy when the final values of the market make its determination. So that's that. The overnight reverse repo stuff for those in AMC and GME, it's still extremely high, extremely high. People are still shuffling money between the repos, and I don't know what else they're borrowing money overnight, possibly to make runs or puts or shorts on specific stocks that have caught the hedge funds by their pants down. The Treasury bonds are increasing, which is a sign of what the rates will be doing soon. So people are going into the 20-year bonds at the moment. Today specifically was a big burst, and really it's been for a while. So we're seeing a very big sign in bonds for interest rates increasing. We're basically seeing a lot of people moving out of the market, entering the bonds for a safe haven, possibly again because there's more fear in the market, and they're essentially trying to hedge themselves in a safe manner. So what am I doing at the moment when it comes to the market? I am kind of split. I need to see a few more volatility bars, even though I'm almost convinced we're going down. Because it could be a fake out, and we could see that the institutions see a good chance to fool the market with news and with fear, as we have always seen with fake news in a general sense. And what's going to happen in that case is they're going to buy at a good value, and then they're going to continue the rallies. This has happened before multiple times. We see it here in September. They made a pretty big swing down, but still the bars weren't as big as what we're seeing now. That's really my concern, is that the volume is huge at the moment with big movements down. And we did see this when the first time we saw COVID come around. We dropped heavy and it was picked up. And you do also see this in here. This is where COVID happened. It went down to our GDP value, very close to it, but bounced right back up. So potentially we could see another sort of big drop and then a reversal. I'm waiting to see some of these particular signs that we're going to keep going for that big drop down, and possibly buy a little bit more, nibble, not buy a lot, but possibly nibble at some lower values so that I can gain with future growth. Because it's not over ever. You know, there's no end to this. There's always money to be made. The key scenario is whether you're going to be holding on the way down, or whether you're going to put some money on the side and you're going to wait for that cheap discount buy. Right now I'm kind of 50-50. So I haven't completely left stocks, but I have bought some dips, like in PayPal. That was a very juicy dip, and I'm actually hoping PayPal goes down so I can buy it near 140. Maybe below 100, which would be fantastic, but I highly doubt PayPal is going to go that low in a general sense. And finally, I had another, the Nasdaq indicator here. So this one actually is interesting, which I'm actually highly attached to right now. We are seeing two things. The Nasdaq, which is the 3,000 top companies in the United States, and the bottom is something called the MMTH, which relates to the actual what's the word? MA 200, the moving average of a 200-day value. And this value represents how many companies in Nasdaq, how many of the 3,000 companies are above that moving average 200-day value. And we had a huge bump before when we climbed, but we are seeing a complete kind of drop now. We're at about 38% of the 3,000 companies are above the MA200. Now, in big crashes like what we saw back in January with our COVID introduction, we had a huge drop all the way down to around 11. In other big crashes in the past, we've seen it get very close down. This was in the November 8th mortgage crash, right? The housing market crash. We don't have any further before details because the 200-day value needs 200 days, obviously, right? But it looks like it kind of starts around the 2008 when the Nasdaq started over in 2002. It's a weird comparison there. Whatever the case may be, though, I'm really keeping a track on which direction this goes to kind of see how hard this crash is going to be. If more and more companies get below the moving average 200, which means this number is going to decrease, then I know, especially from this point on, because we're very much in the middle right now, then I can safely assume the crash is going to continue and we're going to have more rundowns happening, more movement down. So this was a new set of indexes, tools that I really did like, and they give me a very good sort of symbolic kind of side view of how our market's doing on that Nasdaq and how the actual 200 MA is doing overall. So I like to look at these two, Nasdaq and the MMTH together, and then of course with our SPY, which I don't actually have here. With the SPY, oh yeah I do. Well, no, I have the volatility. Let's just put SPY here. And with the SPY, I like to have the VIX, even though technically they're just inverse of each other. But I do like to see the supports and resistances of the SPY and see how that VIX is acting. And on the side, I like to watch the put calls on the market, because honestly, this is where the money is being bet currently at the moment. So even though we could be reversing with actual shares being bought and then sold at a higher value, the put calls are trying to predict the future. So this is going to actually give us a better view of what's going to happen, while the current SPY and the current volatility values are kind of predicting the current moment, right? They're not going to be very good at predicting the future. So I always like to have the PCC out. So I'm watching potentially what the overall kind of sentiment is for the future. And for VIX and for SPY, I'm just looking for those particular supports to see if we're going to actually break them, which looks like we're breaking this one. Probably going to go down to 445 territory, further down to 430. We'll have to see. But with the VIX increasing, the puts increasing, and the SPY decreasing, I believe we're going to have a rough ride ahead of us. So, right, currently I'm 50-50 on market and cash and crypto. Cash and crypto kind of on the side. They're interchangeable. For cash and crypto, I probably have 25 and 25%. So I would say 25 cash, 25 crypto, 50 market. But I do plan on keeping an eye on this and acting accordingly if we break some very sort of fundamental, well, not fundamental, some very important supports. I'm going to start selling off more and more, possibly to 0%. So it really depends on the next week, starting Monday. So yeah, that's what's happening. Chaos. Chaos. Losing money is a part of the game. Winning money is a part of the game. You just can't have any emotional attachment to what you're doing. Otherwise, your actions will be illogical, and you're going to basically act on emotions and not founded reasoning. So that's it. Just have to see next week. I see a big red week, unless some big news happens and people realize that it's not as bad. And I don't know. I really don't know. There's a lot of countries overreacting right now, so potentially the fear is going to grow. Oh, and then let's do one last thing. Fear and greed index. Let's see how that's doing, which I'm pretty sure it's doing pretty bad. Yeah, we're approaching extreme fear in the market, which means people selling off because they're scared, which means I think we're breaking the barrier between bullish to bearish. I think we're going down. This is the overall sentiment now. So a month ago, a year ago, a week ago, fear. Today, previous close, extreme fear. Well, 25, so I guess we have less extreme fear, but it's still pushing its way down. And that's all I have for today. I'm going to keep an eye on the markets next week and report as I go.